shifting positioning from what's worked from the April rally to October is a good idea. High beta animal spirits, I would start to reduce that and start to shift towards the opposite side of the pendulum.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next.
Ladies and gentlemen, welcome back to the Wealthion podcast. I'm Chris Perkins, and today I'm with Ram Ahluwalia, the CEO and founder of Lumida. How are you today, sir?
I'm doing well, Chris. Great to see you. I know we were spending time together in Miami at the Cantor event, and I know you and I are also on another pod too, and we always enjoy exchanging views with you.
Yeah, I'm excited to deep dive with you today. There's so much going on. For the listeners, first, I'd love for them to learn a little bit about your background.
Sure. So I grew up in markets and banking, been obsessed with investing in banks for a long time. First job was at a community bank when I was 14 years old, earning minimum wage at the treasury desk of a small community bank. And I just can't seem to run away from banks. In 2008, I was at Merrill. I lived on Wall Street. I worked to World Financial Center. I saw the financial system blow up due to the lack of transparency around subprime mortgages. That planted then the seed for digital assets. So I got involved in digital assets in Q4 2013 when I was asked to diligence what's now known as LedgerX. And so kind of the rest is history. I built and sold a fintech platform called PureIQ, which was focused on analyzing bonds that don't have loan level transparency. Sold that to Cross River, where I built the crypto business there. So love building, love markets, and I'd always been focusing on what the next iteration of innovation is in this important ecosystem.
I didn't realize you were involved with LedgerX. I was too back in the day. The first clearing.
It wasn't called LedgerX back in the day, if you recall correctly. It was like NYCX, some random name with a terrible deck.
Interesting.
And the funny thing about that, by the way, the price of Bitcoin then was like $180. And I remember a VC had reached out to me and they said, hey, look, I can see why you looked at it because there's a clearinghouse.
Yeah.
Given your background at the CFTC. And they're like, Ram, you know one or two things about this category. Why don't you get a view on it? And meanwhile, the move was just go buy Bitcoin. That was the move.
Well, that's been the move. I mean, to this day, it seems. Well, we're going to talk about that. But before we do, tell us about Lumida.
Yeah, so we're a modern wealth manager focused on founders, exited founders that created wealth. They care about performance. They want access to pre-IPO deals. They want to mitigate tax. They want a holistic approach that includes an emphasis on health and longevity. So, when I exited Cross River, I looked around, I interviewed these wealth managers and realized I have no idea what they're doing. And they're just pushing product. Their incentives are not aligned. And there's no modern interface. It's not AI enabled. And they're not selective around the types of opportunities they focus on. They're pitching 60-40, which I don't think really makes sense in a higher for longer inflation environment. So it's really against that backdrop where I said, gee, there's a real opportunity here to build a modern wealth manager and disrupt the legacy approach to doing things. So we're innovating on the user experience through an app. We're innovating on the offerings and the deal content. We're innovating on the approach to investing as well. And so we're having a lot of fun. We're growing quickly, and we're number one recall for wealth management, certainly for founders in the digital asset space.
Got it. So you're focusing not only on the investments themselves, but the user experience, and you're really saying the 60-40 is dead. So can you deep dive a little bit further on your approach? If 60-40 is dead, what do you see as the rightful outcome here in the inflationary environment you just described?
Sure. So first off, everything starts with the client. What are their objectives, risk tolerance, their time horizon? What are they planning? Everything starts there, right? So there's scenarios where U.S. government bonds may make sense if you need to preserve principal and you've got to save for a down payment in 6 months. Sure, I get why you might want to have T-bills, but most of the time there's better alternatives. There are better alternatives in the world that have higher free cash flow and less damage from inflation. So I think that 40 part's at risk. And there are other types of assets that people can invest in too. Equities, I think play an important role in portfolios, but there are other types of asset classes as well that can include, for example, deals that are 2 years from an IPO. I'm not a huge fan of early stage venture. I know it's an incredibly hard category, but
It's tough.
one of the things you can do is you can scan across top performing deals and see who's got traction, who's got a fairly priced valuation, who's got earnings growth, who's got a path to liquidity, and can I get a 2x plus with long-term capital gains and just cherry pick the leaders in the market? That seems like a good opportunity. So we're looking for those kinds of alternative investments in lieu of classic 60/40. And of course, you see endowments do this very well, right? They're taking advantage of opportunities, and they keep, Harvard's endowment's now $50 billion. So that cross asset class type of investing can work. And now with tokenization, the breadth of these investable opportunities are increasing.
Yeah, I totally agree. I think one of the greatest things that's going to come out of tokenization is accessibility. I think we've talked about 81% of companies in the United States, over $100 million in revenue, they're private. And so only a small fraction of the populace can access them. That's going to change. How's that going to turn out? I mean, is this going to be just a free for all where like people are essentially public from day one? I mean, how do you approach that as an investor?
It's a great question. I fully agree. I mean, this is, call it like the internet capital markets thesis. Yep. And, we agree. And as you pointed out, Chris, the barriers to accessing public capital markets are significant from a compliance, legal fees, listing requirements. And so there's a significant underserved market that right now private equity is going after, and companies are staying private for longer. And really, that should be opened up both on the equity side and on the debt side, just as crucially important. People aren't talking enough about the financing side of this. So, it's challenging because most investors, especially small investors, don't know how to assess risks. I saw a company on Twitter yesterday announce that they raised through a public crowdfunding offering. This is a company that specializes in direct indexing. That business model is going to go away because of the rise of other tax-aware strategies. I won't get into that right now. And they said their board had met and they decided to raise money from their customer because that was in the right interest. And I looked at this and said, what's really happening this year is they're not getting another round from their backers. And my critical, cynical take is that they're just raising from the public because they can.
Yeah.
So, investor protection does matter. Disclosure does matter. You do need a concept of curation.
Yeah.
These are difficult issues to sort out and address. Like Coinbase seems to be taking a very interesting approach, which, as you know, they announced a program where it seems like they're competing with, say, the Republics of the world, where they're going to have one listing per month. It's highly curated. Their disclosures, their requirements around alignment of incentives. There's got to be a vesting schedule for founders. So there's got to be skin in the game and alignment. That's a very appropriate private market response to the challenges we've seen, in the market, whether it's the ICO market or other crowdfunded opportunities. So I don't think we've cracked the code, but we're vectoring in the right direction.
Yeah, we certainly haven't cracked the code, and the lines are going to start blurring. You're saying maybe they're competing with Republic. Maybe they're actually competing with NASDAQ. As you start thinking through equity versus token, if it's public, right? So I don't know. I think we're at the very early stage. But yeah. Let's dig into that 60/40 portfolio again. Obviously, you're tailoring the particular. You look at your client, you look at suitability. But what role do you think crypto and digital assets will play? And let's carve out for a second those tokenized assets, like crypto native products.
Sure.
How do you think about them as part of a portfolio going forward?
Yeah. So there's the what and the how. In terms of portfolio composition, there's a role for digital assets. Even within that, there's such a broad scope, though.
Yeah.
Then there's the how, right? Which is the pipes and plumbing and how that transforms things. I think where we stand today, I'm actually more interested in the how. We'll come back to that in a second. By that, I mean, can you wrap a high free cash flow yield investment with a token to transform that to long-term capital gains? Benefit number one, significant benefit, right? Like you can get a 16% return on a private credit strategy that beats the long run return on the S&P 500. But after taxes, after federal state tax, that 16% drops to 8%.
Yeah.
If you live in New York City, I guess that goes down to 6, then after inflation, that drops down to 3.
Yeah.
But if you can wrap that in a token and make that tax efficient and turn that into long-term capital gains, you've seen this with like ESCA, for example, right? They wrap T-bills instead of throwing off income, which is taxable, just accrues the NAV.
Yeah.
It's a major, major value proposition. The second is cross-margining, which I know you appreciate as well. There's all sorts of assets out there in private credit, trillions of dollars out there that are people that are on the balance sheet of a household, and it's not a source of liquidity. That's a great opportunity. So I'm very interested in the how and the mechanics of these things. On the what, I would say, like, I've actually been, on digital assets. I think overall high beta assets, whether it's digital assets, uranium, or I guess like pick your latest quantum computing stock.
Yep.
I think overall these are retreating, including other things like data center. So I think we have this 4-year cycle, and I think folks that have been in the market for a while are selling into like Bitcoin 125. So tactically, I don't think Bitcoin stays above, gets to or stays above like 150 from where we stand today. Obviously, if we get stimmy checks, we saw this $2,000 comment from Trump.
Yeah.
That takes congressional approval, number one. Obviously, we're in a trajectory of lower rates. However, the magnitude and scope of this stimulus is simply not the same as what we saw during COVID, when you had back-to-back trillion-dollar stimulus packages, and we're not going to see the 10-year at 1.5%. And again, both of these, this takes congressional action. So I think this is actually where we are positioning wise. I'm more focused on quality compounders, financials, healthcare, looking at defense tech plays, that data center energy plays. I think that's a very promising opportunity, and just still have digital assets exposure, but I'm selling on rallies is what I would say here.
If you're looking for a simple, secure way to invest and own physical gold and silver, visit our sister company, Hard Assets Alliance, at hardassetsalliance.com. That's hardassetsalliance.com.
That's really interesting. You seem to be indicating that you're a believer in the 4-year cycle, and particularly on Bitcoin. Is that what I'm hearing, or is it more than just that? Am I oversimplifying?
I think it's more than just that. Part of it's it's like follow the flows, and what do you see actually happening out there? Oh, I don't know that it's not that a religion on this 4-year cycle, but you can see whales are selling at key prices. And when I talk to people in the market, we have clients that have invested and created wealth in this category. I ask them what they're doing. And so you tie out the hypothesis with the on the ground, the behavior.
Yeah.
And, you can see these distributions taking place. So I'm looking for evidence for and against the 4-year cycle. I'm just seeing evidence that people are responding to it. Now, does the market clear this out at some point? Sure.
Yeah.
I'm going to wait for evidence for that to happen too, rather than try to guess when that happens. And look, I think between now and year end, or even a month from now, I'd be constructive overall. But this is like tactics, squiggles versus the trend.
Yeah, for sure. I'm constructive as well. This is how I'm kind of seeing it, and I would love your take. So I feel like retail, they're selling, right? A lot of retail selling. They got burned in what we call 10/10 or Black Friday. We talked about this in the past. This was around all the liquidations and the perps. Those really degen crypto native folks. So they got hit. Then you have those big whales who have seen 3 cycles now of getting of the cycle, and they're like, okay, the time is the time. I've seen this before. Made a lot of money. Like, my life has changed forever. Generational wealth here, guys. It's time for me to sell. And so I see retail for those 2 reasons pulling back, and retail moves really fast. Of course, there's a big part of retail that's chasing the hot ball of money. I think now they're in the privacy, vertical, and looking at Zcash and stuff like that. Who knows where they're going to go next? It's sometimes difficult to participate. But against that backdrop, you have the institutions slowly, steadily, methodically moving forward, no turning back. And I think right now we're in this like gap where retail's moved faster than those institutions have replaced it. But I think we're coming into a cycle where the institutions now are going to be driving. And like, how do you agree? And like, how do you play that market?
Yeah, I think that's right. And it's a great point, and it does go segment by segment, like you mentioned. And there's sovereigns that are playing an increasing role. They're looking to utilize their idle energy needs in the winter, where they don't need to cool their apartments, let's say in the Middle East, and using that to mine Bitcoin, for example. That's different from secondary market flows, though. So, I think if you take a step back, like the big picture macro from our vantage point looks very constructive.
Yeah.
There's a lot of fear out there. However, the two concerns I have is liquidity fragmentation and attention fragmentation. By attention fragmentation, I mean, you've got the AI narrative, you got the quantum narrative, there's a biotech narrative, there's a small cap narrative. And then even within digital assets, you've got the DAT narrative. And, what we saw there is we saw a proliferation of IPOs. And then you saw parabolas there, and then you saw a breakdown in there. And what happens is, I put this on the kind of the weight of evidence scale. When you see new issue IPOs not make money, that's when risk appetite generally retreats. That's when I want to pull back. When IPOs are being rewarded and they're going up and they're quality deals, people are making money, it can continue. But the vast majority of these now are below their issue price. So it's hard to keep the flywheel going with that backdrop. And as you said, hot money, a ball of liquidity. If you look at these other themes, like the data center theme, you had Sam Altman give a disastrous interview with Brad Gerstner from Altimeter, talking about they've got $13 billion in revenue and they've got a quote unquote $1 trillion in committed spend. You and I both know the word committed spend is the same word for like debt. Like, what does that mean? Is that like off balance sheet liability? That doesn't sound too good to me too. So data centers are in retreat. And generally people that own these assets, like digital assets or the data center theme, they are betting on the future. It's generally a good bet to make, but they're all in these similar crowded themes, and those themes one by one are pulling back. They're getting margin called on them, so that they retreat more. I think that's the current market climate, that we're in. So I'd rather own things like Meta, which is down 20% from its recent high, despite the fact that it's growing earnings like 35% year over year, and had a one-time charge due to tax rather than excessive CapEx.
Yeah. So it sounds like you're advising clients pull back from those frontier narratives and really get back to fundamentals. Look at cash flows, look at fundamentals, look at the blue chip.
Yeah, look what's working.
Yeah.
Insurance and financials are working. Look at like Allstate. It was 7 times earning, now it's 7.5 times. Those things are quality compounders and earnings. There's a tension between animal spirits, which are the high beta, thematic, Momo, FOMO names, tradery names, and the exact opposite, which are like these quality compounders, free cash flow, buybacks, growth, quality, right? And this high beta rally, we had a massive high beta rally off the April lows after they were absolutely destroyed, right? You had like -2 standard deviations on that high beta category. Now you went to the exact opposite. And these other areas have been kind of quietly ignored. And those includes like natural gas midstream pipeline, which you need to power data centers. These are quality businesses and quality categories with earnings growth. And they have an important role to enable the next leg here in terms of powering, say, energy, for example, or providing financing in a deregulatory backdrop as well. So I think that's where the capital is going to flow. I think that's where the institutional bid is.
Right. So even in equity markets, if you weren't in the Mag 7, you've been left behind. So now what you're saying is time to pivot back, look around, and find the value
like
that you've missed.
Meta is still fantastic. Exactly. I think there's still quality names even in Mag 7. I mean, a lot of them have re-rated, right? Like Google went from death of search is going to take out Google. Now it's like all-time highs, and they, all these hyperscalers are showing double-digit revenue growth in their cloud businesses. So one thing that we should all be clear on is that there is ROI on this AI CapEx, right? Michael Burry came out a week ago and said, "Hey, all this round trip, this is a bubble, etc." The fact is, there is ROI on this CapEx, and it is showing up in earnings. You see that with Amazon, you see that with Google, You see that with Meta. So that data center thesis fundamentally is still there, which is constructive. And we're seeing productivity growth across the economy at levels we have not seen since the late 90s, when we had another innovation come on the scene, of course, the internet.
Yep.
So, for those reasons, I think we should still be very constructive. In fact, starting to look at these industry groups that are going to be benefiting from AI adoption, like financials. If you look at financials, the penetration of AI is changing call center servicing. It's improving credit underwriting, creating more efficiency. Bank of America CEO Brian Moynihan talked about how they're seeing a double-digit improvement in their tech release productivity. That's just one example. Now, call center innovation is coming too. Better Mortgage has this technology with Tin Man and Betsy. It's an AI LLM that increases productivity of their team. So you're getting more done with less. That's a great story, this deepening of AI across sectors of the economy.
So you're very constructive on financials, where some of my crypto native bros will say, no, crypto's going to eat the financials. You're not, you don't
They're
agree
true
with that?
too, right?
Yeah.
I agree with that too. It's really funny, right? Like Visa and MasterCard have a lot to lose.
Oh yeah.
Right. So
but they seem to be leaning in.
Part of that talking about?
Yeah, they seem to be leaning. They seem to be leaning in, though. That not all institutions are. It's not fair for me to paint them in one brush. It feels like you've got some folks that are leaning in, some folks that are like, "Oh crap, I'm not interested," in other ones that are trying to fight.
You got to break it down, right? So you've got MasterCard that bought Zero Hash, incredibly thoughtful acquisition. Zero Hash provides fiat ramps. The world needs more fiat ramps for digital assets. So MasterCard helps enable the movement of money. These small community banks are under incredible pressure with the rise of stable coins, right? Yep. So it's hard for them to compete on the deposit side. So yeah, there's a lot of pressure on that. But think about financials, like insurance companies, they are protected by licensing. They've got a moat.
Yep.
Right. It's hard to take that out. How does that go away? Now you can innovate with like lead gen. You can innovate with customer servicing. AI will improve those business models from that perspective. And then, certain banks that are tech forward, I agree. Banks are interesting. It's like a double-edged sword. Most of them will have risk, but those that can innovate, they'll take more market share and they'll be a beneficiary of growth. Those that are leaning forward into the category, right? There's a bank that Palmer Luckey just backed that's going to finance GPUs, for example. That's a new market. Now, there are other banks like Lead Bank. Jackie Reese spun out a Square. She bought Lead Bank for $56 million. 3 years ago, they did a round of financing. 2 months ago, at $1.5 billion. They power Stripe.
Yep.
So the folks that enable payments, these fast-moving, high-flying fintechs, somewhere in the back end, there's a bank, an infrastructure bank that moves money, custodies, provides financing. So they'll still play an important role. Deposit insurance confers low-cost capital. You and I know the deposit insurance fund, which is, I don't know, call it $100 billion plus, it's not enough to actually protect deposits, which are $20 trillion.
Yeah.
But deposit insurance still confers low-cost capital, and low-cost capital wins the game. You need that low-cost capital in digital assets too.
Yep.
So I think it's highly bifurcated. You're going to have a concentrated pool of winners in financials that'll do extremely well. And overall, though, they're still, that category is still posting double-digit earnings growth, and the valuations are great. They've got buybacks. I think JP Morgan's pricey. I was a buyer of it 2 years ago. But if you look at the return on equity of their consumer bank, it's 30%.
Yeah.
The largest bank in the world is compounding at 30% the consumer bank. Those are big numbers.
That's because they keep all the interest, right? Now stable coins are coming around.
They pay 0% out on on demand deposits. But not, to your point, you've got other risks like the Fiservs of the world and the Jack Henrys of the world, and these infrastructure providers, these community banks. They're under pressure. So you do have to pick the subsector appropriately, but the moat and the advantage you have from the license of a bank charter, of an insurance company, is meaningful if you're tech forward and indexed to the right categories.
Yeah. The one thing I noticed was that after Dodd-Frank, I watched that moat get really deep. And anytime you've got a deep regulatory moat, it really forces consolidation because the regulation defines what you have to do. It's commoditized at that point. It's so like revenue gets squeezed and you got to be big as hell. Now we're seeing the opposite happen. It feels to me like the regulatory mode is getting more shallow. And so I feel like you're going to see more competition, whether it comes in from crypto or somewhere else. How do you take advantage of that environment as an investor?
No, you're right. Right. You've got like 200 fintechs applying for an OCC charter, and the OCC will hand them out these conditional charters. So competition is coming. I think it's hard to pick winners. It's so early.
Yeah.
There's not product market fit, and an OCC charter doesn't confer FDIC insurance, which is a low cost capital thing you really need if you want to lend as a bank. And if you're going to be a bank, as you and I both know, it's so incredibly regulated.
Yeah.
ALCO meetings, board meetings, supervision, FDIC examinations. The juice is worth the squeeze only if you're lending. If you're lending, you better be lending. If you're not, then you're not getting the 10 turns of leverage that you have as a bank from that, from 10% tier one capital. So I think, how to play it. There are opportunities there where there are certain banks that are specialized that focus on the customer. They've got a unique edge in that market in terms of customer acquisition. And I think those banks will still be fine. Right. So, payments is a tricky cat. I wouldn't want to bet on payments, on the other hand. So incredibly competitive. It's a circular gunfight. And if you look at, you can see it. If you look at the stocks like PayPal and its peer group, they're all competing for ever smaller margin.
Yeah.
And it's the competition so well capitalized that I think payments is a very hard category. And the great thing about being an investor, especially in public markets or liquid assets, you don't have to play that game. You don't actually have to pick the winner. You can choose which ponds to fish in and which ponds to avoid.
You have ball control. Yeah. What do you think about the Western Union Solana deal?
Well, what's interesting about that deal? So Western Union has been around for like 150 years. So international remittances, which they lead in, still plays an important role today. It's the business that every VC, myself included, just wishes would just get disrupted one day. And we keep looking at this thing. How is this still out there? This is Western Union, right? And it's a brick and mortar style approach, and it still has relevance in emerging markets. So I think one of the interesting takes about this Western Union deal is I believe Solana paid Western Union something like $30 million to get that deal done. So who has the balance of power in this, right? I mean, I don't know the background behind that, but did Western Union have an auction? Was Stripe a part of that auction? Their new L2, call it Tempo, their new chain L1 called Tempo, et cetera. The folks that own the customers have the leverage. They have the bargaining power right now because you're seeing hyper competition on these chains focused on payments to get usage and adoption and demonstrate real world use cases. So
100%.
I want to see Western Union go away. I think they will. I think folks like these big tech companies, Meta, for example, they have WhatsApp. They tried to launch Libra and then DM, and that was canceled in a different admin and different regulatory regime. They're not doing that now, but if they did, it would get through because it was fully compliant then, but it's constructed. But those big tech companies are positioned to do well because they own the customer. The customer lives in their platform. They have day-to-day interactions. And we've seen this play out in China. China is actually ahead on consumer fintech. They're using Tencent apps and Alipay to move money and send gifts like red envelopes to each other. They've been doing it for years.
Yeah.
And it's social media driven payments. This is why you have the rise of the super app.
Yeah.
The super app is this all-in-one banking app that does social media and payments and banking and investing. So I expect that Grok, Twitter will get after this quickly. It makes sense for them to do that. Coinbase is trying to get after it. Robinhood is. What's Amazon doing? They will do something. So I think betting on those players to continue to compete and win makes sense because they have a relationship, with the customer.
Yeah. So, I mean, Chairman Atkins is talking about super apps all the time. And I think he's thinking about securities and crypto coming together. But I think you're right. I think it's much bigger than that. Who's going to, and you're going to see these regulatory moats being lifted. So maybe a Twitter jumps in and maybe Robinhood.
We'll see. I hope more of the moats are lifted.
Yeah.
I hope more of the moats are lifted. Like the big moat right now is this. So, I have on good word that when the Genius Act was being drafted, which, as you know, introduced stablecoin regulation, that Jamie Dimon and his lieutenants marched down to DC and said, hey, if the Bank Holding Company Act means anything, then you cannot let technology companies compete and offer banking services.
Yeah.
So this Bank Holding Company, I'll be brief on this, it prevents technology companies or businesses that are quote unquote engaged in the activity of commerce from offering banking. This is why Amazon, which owns Whole Foods, doesn't have a bank branch. You'd expect to see a bank branch in every single Whole Foods. It's the reason why Google, which has hundreds of millions of consumers and tens of millions of merchants, why they don't have a payment network that competes with Visa, MasterCard. So that mode is still not lifting. That is the biggest mode in town. Other modes are lifting on payments for these specialized fintechs with an OCC charter.
Yeah. Getting back to the Western Union side of things, there's one big trend that I've been noticing that people don't realize, and I'd love to get your take. So in the old days, when I was running business at Citigroup, I would pay my vendors, my tech vendors, $80 million a year or whatever. Like, buying tech is a huge, huge expense on your balance sheet. But now, to your Solana point, and I've seen this with other chains as they're integrating with these legacy enterprises, they're like, wait a second, I will make you money. I will make you money on sequencer fees. I will, in certain cases, pay you to onboard, because the ecosystem and the network benefits from having these big super apps on the system. So it's almost now, what happens if you are the big enterprise that continues to pay for tech versus the one who's making money on their tech? Are you looking at that as you seek, your investments?
Well, I love the picks and shovels infrastructure play.
Yeah.
Like when you've got rapid proliferation, rapid CapEx investment, looking the layer deeper at the picks and shovel layer makes sense. In AI, that has been names like NVIDIA and Taiwan Semiconductor. So in this payments category, from a private markets perspective, it might be, for example, like Stablecore or Omnia, which are two startups that are helping banks become stablecoin relevant, because the banks just can't adopt or innovate on new technology, just rent from someone. So I like that. I like the picks and shovels play. It's just so competitive at the application layer.
Yeah.
I agree. I think those are interesting areas to focus on in private markets. Now, the thing is, it's hard to express a good view on that in public markets.
Got it. Let's pivot.
That's where deals have a role, right? That's what we talked about earlier. Like where deals have a role, because you can, you have these amazing businesses that are just staying private for longer. Look at Stripe now. I don't know what it's worth now, but it was $80 billion once upon a time.
Yeah.
And that deprives public market investors of access to attractive sources of return.
100%. Let's pivot to macro a little bit. So the government's starting to open up again. I don't know how long it's going to stay open, but looks like we have it's back on. How do you see, what macro inputs are you really tracking? What are you looking for? What's important to you?
Sure. The primary things I look at are, number one is corporate earnings growth. Tell me the direction of corporate earnings growth. I'll tell you the direction of the stock market. So earnings growth is strong, double-digit year-over-year growth. In Q2, we had 12% year-over-year earnings growth. Now it's like high single digits. So that's robust. And the reason why that matters is that the marker of recessions are layoffs.
Yeah.
And corporates do not lay off if they have earnings. They need talent.
Yeah.
They need labor together with their capital to drive more earnings. So number one is earnings growth. Number two is the pattern of inflation. And in general, we have a pattern of disinflation. It is kind of sticky here, but it's not heading up. And the Fed is biased to cut despite that backdrop, and maybe tacitly accepting a higher level of inflation, which is constructive for real assets. Real assets are things like stocks, homes, commodities, as opposed to fiat assets such as debt, where you'd rather be a borrower, so your debt gets inflated away. So then I also look at the productivity growth. Productivity growth is the only free lunch in economics. Productivity growth enables a company to grow earnings and pay more to their workers. And so that's the climate we have. So actually, this is Goldilocks. This is Goldilocks economy. This is great. What the mismatch we have is that people don't perceive it as Goldilocks.
Right.
Which is ideal, because
it's a constructive setup.
That's right. If people see the world as Goldilocks, that means the assets are expensive. That's when you have the Time magazine cover of it's Goldilocks and everyone feels chummy and happy and the valuations are high. And that's probably when you want to, de-risk a bit. So I think it's a very constructive environment. That people have PTSD from 1, the April tariff war, 2, government shutdown, 3, there's still geopolitical risk around the war, around the world. So there's, that people have these tensions, and it's manifesting in, kind of the recent election outcomes. So that's why asset prices don't reflect that, but that also creates the opportunity. A lot of people are concerned about recession.
Yeah.
I mean, it comes up so often when we talk to our clients and others, which is actually another contrarian signal for me. The sentiment is too bearish, and a lot of people are off sides in terms of positioning. Meaning, if you look at long short managers and you look at their exposure to U.S. equities versus their historical trailing exposure, they're well below their medians. So what that means is when markets rally, they're forced to performance chase into that. So they will buy dips. They will buy dips to increase their net exposure.
So you're risk on then generally, but you should still seem a little bit, what's the word? You don't seem to be full throttle risk on. You seem to be very careful.
I would say, so the resolution, so on beta and risk on, yes.
Yeah.
The resolution to that tension, which you noted, is positioning under that. It's the asset allocation within that risk on environment. So I think shifting positioning from what's worked from the April rally to October is a good idea. High beta animal spirits, I would start to reduce that and start to shift towards the opposite side of the pendulum. So that's the kind of reconciliation of this.
What I'm hearing is hardcore focus on fundamentals. Like get back to fundamentals.
Real business with earnings growth, with decent valuations, growth at a reasonable price that can compound and grow. That includes technology stocks that are not insanely overpriced. I still think Meta's great. I think other names in the semiconductor stack are fine too. Data centers got a bit of a hangover because it is attached to the high beta, but fundamentally still good. Healthcare is great too. Like the worst of the cutting Medicare Advantage is behind us. You saw this aging demographics. You have a baby boomer economy. The demand for services in healthcare is only increasing. And you've got the government is your customer there. That's a creditworthy customer with growing spend. That's a great category. Financials are great. Defense tech is also interesting, maybe especially in private markets, actually. Anduril's too expensive, but there are other companies, maybe like Shield AI, that are doing full FSD for drones, right? Autonomous drone flight. You and I were at this Cantor Fitzgerald conference yesterday, and the Undersecretary of State and Ted Cruz, I believe, rightly pointed out that having 12 fielded carrier battle groups makes them ripe targets and maybe in day one of a war with China. And then you served our forces, so you have a better insight on society. But look, I believe it makes sense. Like, better to have smaller, cheaper, faster drone technology. So I like that. On private markets, I think they're really good defense tech plays to focus on.
I couldn't agree more on the defense side. Having been
able to catch
grad, like honestly, if crypto has taught us anything, it's decentralization that really drives resiliency and scale if you do it right. And I think that's the trend that we're seeing across the armed services, like the Marine Corps is doing a distributed type approach to warfare going forward. It's all kind of intertwined in my mind. It's really interesting stuff. Awesome.
Agreed.
So you talked about some of the companies you're excited about. You mentioned Meta a bunch. What's the most under-owned asset? If we carve out Meta, you talked about how excited you are about it. Asset or vertical?
I'll share a screen real quick here. And by the way, I just call that as example. We have like 50 different positions here, but I just call that. I think within Maxim, it's like the cheapest one out there. But like, here are high level investment themes. I'm sharing on a screen for those that are watching. But it's the nuclear renaissance. The world needs more nuclear energy. It needs all of the above energy, but nuclear is a big part of that. Aging and longevity is a big part of this too. We have aging demographics all across the world, including here in the US. They need services. They need nursing. They need care. Digital assets, fintech, we talked about. The rise of AI, defense tech, we spoke a bit about. the data center and energy infrastructure build out. There's a data center not too far from SF that's got capacity, but they've got no energy. It's just sitting there idle. I think mortgage refinance is a very interesting theme now. We've got 3 years of higher for longer rates. I believe rates are coming down. You've got the privatization of Fannie and Freddie. The reduction or elimination of the so-called G fee could cause a mortgage refinance boom, which is great for consumers, and certain mortgage refinance names will do well. I think biotech is extremely hard category, but there's select areas within biotech, especially those areas linked to oncology. I think those areas can do well. Biotech's generally been a go nowhere category for 3 years. So I think a lot of the excess have been kind of washed out. And this is a big one for us, like the baby boomer economy. I don't think people have really kind of focused in on this, but if you look at restaurants, you look at travel and leisure, the effect to healthcare, elective health, there are a lot of sub themes in this baby boomer economy. Cruise lines. We just built a 5% position in Norwegian Cruise Lines 1 or 2 days ago, actually. Wow. They've got backlogs. They have a backlog. That means they've got future revenue in hand, double-digit earnings growth, and you're buying at a forward valuation of 9 times. There's also this, call it the Degen economy, right? The rise of names like Robinhood and sports betting. There's quite a few names in there. I think you got to pick those spots really well. Obviously, Coinbase is part of this, but a lot of those names have rallied and are expensive right now. So I think timing this is tricky. But there's a big market of these DIY investors that are taking investing in their own hands, and you're seeing turnover increase. So one of the ways I express that is through Virtu. So Virtu is the only publicly traded market maker, and they're indexed to the launch of and growth of these ETFs. So you got the 3X bull bear, 5X bull bear ETF on any other theme under the sun. What's the picks and shovels expression of that? It's a name like Virtu. The market makers are providing liquidity. I like a name like that. And it's also, they benefit during periods of higher volatility. So high single digit forward PE, it's with double digit earnings growth. So I like those kinds of themes, and those are some of the ideas that we're investing against.
Started by a West Point grad, I'll add. On the Degen economy, how do you play prediction markets? It looks like everybody wants
That's a great.
Yeah,
you're right. We both, I think we were at the conference where we saw the Polymarket CEO talk about this. I think, and private markets is really how you do it, but you got to look at the valuation of this. Everyone knows Polymarket now. Yeah, there's nothing non-consensus around Polymarket. It's definitely heavily shopped and efficiently priced. So you have to have a bet that they'll have continued product innovation growth that will get additional traction, or that'll be well received in public markets, which it probably will be, just because it's Polymarket and it's a consumer brand with a retail following, including amongst Degen traders. That's kind of the recipe, by the way, right? Yeah. There's a reason why Robinhood, Tesla, Palantir, and SoFi have these stratospheric valuations. 4 out of 5 of them are consumer brands. And it's this read, write, own economy where shareholders are consumers are shareholders. Yeah. And they just bid up the valuations on this thing. Polymarket has those attributes. Yeah. But it's not a fundamental underwrite. It is a repricing underwrite, which isn't necessarily bad. It is what it is, right? Like it probably does re-rate, but I haven't dug into the earnings on this thing. So I haven't focused it, but that's like a private markets bet. Yeah. In public markets, there's a stock that I call it stalking, meaning it's on our watch list and we're just waiting for a good entry. So that means everyone listening to this might front run me, which would be unfortunate. Please don't do that, or let me know when you do. But the ticker is Genius Sports Limited. I'll see if I can share my screen on this real quick here. But you can see how it seems to be setting up right now. It's given back quite a bit, which I like. But you can see this is a business that overall has a good trend. This business, they focus on sports betting. It's got a 26 times forward PE and strong long-term trend. And it's given back recently along with these other kind of Degen economy, high beta stocks. So I think sometime in the next couple of weeks, that may be an example of a way to express on this. And it's a lot cheaper than Robinhood and probably a lot cheaper than Polymark. I don't own it right now. I'm just giving you an example of how you might express it on Degen economy.
I imagine $2,000 stimmy checks may help boost that.
Oh yeah, if that goes through, then that we'll see. You'll get you'll get some lift on that.
Yeah, for sure. All right, so we talked about underowned. What about the most overowned assets? Anything that you think is not worth the time?
Great question. Overall, I would say like the positioning is still dour and the sentiment is dour.
Mm-hmm.
So what's overowned is probably like T-bills.
Interesting.
Sovereign debt is overowned. You've got T-bill yields at like call it 4% and an inflation backdrop of 3%. I don't know why people own bonds in the current environment. You can own equities that like royalty pharmaceutical companies. I'll show you this company that we do own, and it's called Royalty Pharma, and this company has a very attractive free cash flow yield, and they're making revenue through royalty streams. So that this is a company, ticker RPRX. The free cash flow to market cap yield is 14%. It's gone up about 58% in the last 1 year, by the way. So you're getting valuation, you're getting momentum, and you're getting a quality business. I'm not saying the entry is great where we stand, by the way. I'm just giving you an example of why I wouldn't want to own sovereign debt, because there are other assets in public markets that are linked to yield and are real assets. So they reprice in response to inflation. So the most overwhelming thing is sovereign debt, and maybe things like Palantir stock, I guess, although I've been saying that for a while. So I don't know.
Interesting. So you're long defense, but short Palantir. Get it.
Well, I'm not sure. I'm just saying like 250 times PE ratio where all the insiders have sold out. Like Alex Karp hit like sell. Peter Thiel hit sell. Joe Lonsdale hit sell. And they're very good at the market. I have a tremendous amount of respect for Alex Karp, by the way, personally. Yep. I love his message. I love his defense of Western civilization and American values. And like, I'm an Alex Karp fanboy, just to be clear. But there's a difference between investing and like the message and all this. And, if you look at, you had a lot of these high beta stocks for call like a year and a half ago. Remember Kava, like Sweet Green, Chipotle Mexican Grill. They had these massive double-digit rallies. I'll pull up a few of those charts for those that are watching on screen here. I remember in May of last year, I noted that it was a terrible time to buy restaurant stocks. The theme was just overbought, but that's been correcting. So at some point that's going to bottom. This is Chipotle, this one hell of a rally from the end of the bear market in 2022. It's almost fully retraced, right? Almost fully retraced. And the valuations are becoming more reasonable now, right? So Kava, you could tell a similar story. It's a massive bull market where this thing was the poster child, massive rally and given back 60% of the gains, right? Still in a bear market though, right? But overall though, like at the big picture level, I think it's high beta stocks that are overowned. So it's kind of like time to do the opposite. It's, quality compounders, free cash flow,
got it,
earnings growth.
Let's pivot to crypto real quick. Are there particular verticals that you think are particularly exciting or not exciting?
So in digital assets, like I think on tokenization thesis, incredibly excited about this, been writing about this.
But you can only access that really via private markets, right? Or is it more of a BlackRock play because they're embracing it? Or
I agree. In private markets, it's tough also, right? Like these are all expensive names, and this is what you do as a VC, of course. And I'm valuation sensitive, so I'm like I'm waiting for the good deals. But I think there are. I'm focused on it as a theme. We did an investment in a private company called New West Data. We just closed on that, and this is a company that does, it's like the next Crusoe, I call it. So for those that don't know Crusoe takes off-grid energy from natural gas, and they are powering OpenAI. So they've got a $10 to $12 billion valuation on a big commercial agreement from OpenAI. And they started as an off-grid Bitcoin miner. So they were taking excess nat gas in the Permian Basin.
Mm-hmm.
They'd go to these oil and gas drillers and say, hey, look, you got this nat gas and there's no egress. There's no midstream pipeline infrastructure. It's too remote. They said, let's slap on a generator there. The same generators that Elon Musk is using to power his Memphis data center, and they'd mine Bitcoin.
Mm-hmm.
So we made an investment in Alberta, Canada. It's called New West Data. Great valuation, great team. You know, the former CEO of Hut 8 is on the board, former partners from Golden Tree, Deutsche Bank. And we're getting a 35% plus or minus free cash flow yield through the mining and sale of Bitcoin and the selling of oil. Because in Canada, it's illegal to flare natural gas beyond certain limits, far more restrictive than the US.
Mm-hmm.
And there's a lack of natural gas midstream pipeline egress due to the Trudeau admin for 10 years. They neglected the CapEx. That set up our opportunity where our partners are buying these oil and gas wells at 2 times free cash flow. 2 times free cash flow. This is bananas.
Yeah.
In public markets, that asset trades at 5.5 to 6 times. 2 times free cash flow. Then they put on the generator, they mine it, they sell the Bitcoin at the month end, and then they sell the oil. And so now we're exploring how to tokenize that. Can I tokenize that on chain? Can I get long-term capital gains? Can I send a senior bond off of that to a stablecoin issuer to increase our returns?
Mm-hmm.
So I'm excited about that kind of opportunity, whether you're originating a quality asset that can go on chain.
So Rob, just
I think you got to pick it well though in crypto. Go ahead, yeah.
No, like so when you talked to us earlier, how you're using tokenization to effectively structure products for tax efficiency. You're doing that yourself, or are you working with somebody to tokenize?
Yeah, because no one's doing it, so we'll get after it. We're waiting for someone to do it, and I'm not seeing. You know, I was at there was a conference last week in New York here, and it's a panel, and 2 of the people were talking about AI agents. And the hype is so ahead of the substance. The thing about digital assets, as you can appreciate, there are incredibly brilliant technologists that know how to engineer and build technology.
Absolutely.
And they have a good view of the future. Yeah, AI agents will have an important role. Okay, great. But the near-term commercial value from that is limited or close to zero. That's just the reality of it. The reality of it is that, you know, the existing technology platforms have the reach, the distribution. They'll be the primary beneficiary of this. You know, I think folks in a commercial value near term. Where do I see that? Tokenizing of assets to create tax efficiency. You know, there are other areas, of course, too. I think very soon, I think maybe within a couple months, we will see oversold digital asset treasury companies that have significant discount to NAVs, and there'll be moves to make there. My sense is we might still be too early though, and it is a stock picker's game there. You know, you've got treasury companies that in their offering docs are expressly prohibited from, for example, selling their token to go buy back shares and close the gap. There's no structural mechanism for them to close the gap. Like, they're going to have issues. So yeah, I think there's a lot of promise around digital assets for sure, but I think hype is ahead of reality where we stand today. There are now 580 VC funds. I talked to a friend; he's launching a VC fund. I guess it's 581 now. So it's challenging, right? Like valuation's the enemy of returns. You know, 2013, 2014 vintages of venture were amazing because the market for venture capital was starved, right? You could get an Uber at a $4 million valuation. Now you're seeing pre-seed valuations at $40 million.
Yeah.
So I'm not excited about those opportunities. I'd wait for a de-risked later stage, priced correctly valuation where I get a path to liquidity and focus on that. That's what I'm looking at in, say, defense tech.
Got it. Well, I know I could talk to you all day, and I've already learned a ton. But before we cut it off, just is there anything I should have asked you that I didn't?
No, I think you covered a lot of ground. Look, I'd say, you know, the future goes to founders. The future goes to innovation. Be optimistic. Fight the negativity. You know, this is a Goldilocks economy. We've got a great deregulatory backdrop. You know, stable coins are decentralizing the U.S. dollar. to a
100%.
common standard, which benefits the United States. Productivity growth is great. So be optimistic, invest in the future. If you're young, now's the time to take risk, be a founder, be a part of catalyzing that positive change. It's an extraordinary time to be alive. Make sure you're positioned against these trends and take advantage of that.
I love it. Incredible advice. And I think you're right. It's a golden age, and I hope a lot of people jump into the ring. Got to be in the arena. Ram, awesome to speak with you. Love every time you open your mouth, I learn something. Always a pleasure, and hope we can get you back on soon, man. Thank you.
Same to you. Thank you, Chris.
How can people connect with you?
Oh, you can follow me on Twitter at Ram Ahluwalia, RAMAHLUWALIA, or you can go to our website, Lumida Wealth. We have a newsletter we drop every Sunday at 11 a.m. Eastern, and on topics including macro, trends in AI. We go through earnings analysis. I write it myself with our team. It's very high quality. And we're also on TikTok and Meta. If you look up Lumida Wealth, LUMIDA, you can find us there too. So very active on social.
Awesome. Great to see you, sir.
Everybody. Thanks, Chris.
Take care.
Well. Till next time.
Yep.
Cheers.
Bye-bye.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next. Thank you all for watching. We'll see you again next time.